So my name's Emily. I run Bloomberg's Good Business newsletter, and I'm the sustainable finance editor at Bloomberg, and I've been writing about impact investing for about the past 6 years. And impact investing has evolved a lot. I was just saying the term was only coined in 2007, and GIN started in 2009.
Right.
So it's been 10 years. Could you talk to us a little bit about how the market's grown and how you're seeing different solutions and opportunities now?
Sure.
And you just did the sizing of the market.
Yes.
See how big it is.
Yeah, no, happy to, and thank you all for this opportunity. It's great to be here with you to have this conversation. So just to be explicit about how impact investing fits into this broader landscape of all the different topics that are covered today, the way we define impact investments are investments that are made with the intention of producing a positive, measurable social and environmental impact alongside a financial return. So it's complementary to, but different from, strategies of trying to avoid harm. We're just trying to look at managing down risk, but actually trying to have a positive impact on issues like mitigating climate change or increasing access to affordable housing, sustainable agriculture, and so on. We just recently completed a sizing of the market that Emily was referring to, and this is a global figure where we determined that the market is $502 billion US dollars in size. That includes investments across a number of asset classes and all around the world. I think it's a formidable sum and certainly worth paying attention to. And it is coming from a place where we didn't have great data in the early days, but something much more modest. But I also think there's a great conversation that we'll have here about where it needs to go from here and how it can scale. Because if you're looking at issues like well, the meetings that are happening right now on climate change or the UN Sustainable Development Goals and others kind of broad global goals that need a lot more capital, part of the opportunity is how do we grow impact investment to help move the needle on some of these big global issues?
Right, yeah, that's a really good question. You know, the COP25 happening in Madrid just starting today, I think. And I guess the UN says to reach the Sustainable Development Goals, we need 5 to 7 trillion a year. So from 502 billion to 5 to 7 trillion a year, that's a big delta. So how do you think, Rekha, about achieving impact at scale at Nuveen?
Yeah, and since scale is a relative number, if you think about kind of the larger volume of investment dollars flowing to just investing, impact is still just beginning to scratch the surface. Nuveen, we've invested a little over $1 billion in private equity and real estate focused on impact, and we think that's somewhat at scale. Having said that, I think the Sustainable Development Goals and the agenda for the 2030 goals is much larger, requires a larger participation of investors. And there's a way to do it because I think now there are investors along the continuum of impact investing. You know, I'd say 7 years ago, 8 years ago, you had a lot of investors playing the early stage investing part of impact investing because companies were being born, ideas were being conceived. And now you're seeing kind of investors playing in the growth equity space, which is firmly where we sit. And certainly now the larger kind of mega funds looking to take the companies that have scaled beyond that level to grow beyond and maybe even the public markets. I think that for us, what's exciting is because we've been market participants for this whole period of time, we now have over 50,000 data points. We are going to be publishing our impact report looking back 10 years at what we've done in inclusive growth. And we've impacted 176 million low-income customers. 65% of them are women with financial products, healthcare, and education. We've saved 1.8 million metric tons of carbon emissions, which is equivalent to taking off 380,000 cars off the roads. Preserved 20,000 units of affordable housing. And what that tells us is this can be done, but data is going to be really valuable for the next 10 years. Really observing what worked and what didn't work so that we can make intelligent decisions about how to drive impact going forward. There were a lot of discussions on earlier panels about data and impact metrics. And so this is kind of the next 10 years, is using that great data to drive behavior in a positive way that's going to really solve some of these large SDG challenges.
Yeah, Jackie, I'd love you to weigh in on that a little bit, just looking at how big this space has gotten and how you're seeing capital come into all the different places in the market from your vantage point at Bank of America.
Yeah, absolutely. I mean, it is a marked transition over the 10 years, but even more so, like you say, over the last 3 in terms of the demand that we see from our clients, and that is from retail clients who are showing up, with the first $20,000 that they've saved, wanting to make investments, all the way up through institutional clients. That interest in saying, you know, I want to invest my dollars responsibly, and I want to know what their impact is really growing. And I think, you know, there is also a continuum of how sophisticated that interest is. So some of what Rekha mentions, right? Interest in the environment, interest in gender or inclusion, a lot of interest in what can I do locally, right? What can I do here in my backyard kind of piece. But then an awful lot of folks saying, I want to be invested in better companies. And I am able to be broad with that definition. So it's interesting to see how, I think early on there was a little bit of challenge in this space of, well, I'm interested in, you know, ocean health in the Western Hemisphere, and specifically, and sort of that aspect of, well, actually, if you want to get that targeted, it's a very small, specific, bespoke opportunity, or it's philanthropy. And so we need to kind of scale up and understand the interconnected nature of this, and that's where the SDGs have helped.
Is this, just to follow up on that a little, is this going beyond investing your values?
So I think it is, right? So we see clients coming at this from a number of different motivations. Investing your values was where we were 10 years ago. It was that, like, I want to sleep at night. This is who I am. This is how I grew up. This is our, you know, wherever you want to go. Increasingly, we see people also just saying, I believe companies should be responsible, right? That you could call that values, but it's not the same thing as the traditional, these were my ethical values. It's, I believe companies should be responsible. Responsible companies are going to be those that you know, are the long-term winners. We also see specific, very specific drivers, whether it's healthcare, whether it's inclusion, whether it's gender, and then more so than ever before, and I think Sir Ronald Conan was talking about this, those that just say, look, I want to be on the side of the innovators, right? I believe the next unicorns are going to have an impact focus. And so, you know, so all of those other themes are more than values. It's values and opportunity. It's values and a particular theme.
Got it. Yeah, that's a good point, values and opportunity. Amit, is this like impact investing 2.0? Are you seeing that sort of shift in the market as well from your vantage point?
2.0, 3.0, 4,
Yes.
where are we?
4.7.
Yes. It's an upgrade of some sort. We'll figure out the right number, but I think it is. But one of the things that has been driving a lot of activity, and you know, I assume many people in this audience are very aware of this, is that there's been a massive kind of uptick of interest in impact investing all around the world. I think the Paris Climate Accords are a factor in that. I think the Sustainable Development Goals are as well. And you know, we're seeing a lot more institutional appetite. You know, so large pension funds, insurance companies, other types of endowments that are looking for not just kind of avoiding unethical investments, but trying to have a positive impact on some of the issues that they're seeing in the world. And then we see, of course, at an individual level. Across all generations, actually. I know there's a lot of great data on what's happening in the millennial generation and what that predicts for the future of the financial markets, which I think is a huge kind of tectonic shift in demand that is coming. But even before that happens, I think we're already seeing a lot of professional investors who are managing large pools of assets who are really thinking about what opportunities are they missing, and what they need to do differently to make sure that they're putting their capital to work to help build the world that their clients want to live in.
Yeah, Rekha, I'll ask you to follow up on that. Where are you seeing opportunities today, and where are people wanting to deploy capital? You've done the affordable housing, you've done, you know, that first billion, but where are you seeing this going?
Yeah, first I'd like to comment that the other reason this is mobilizing quickly is because this is really in front of people's faces in a big way. Mm-hmm. Income inequality is something you see when you walk down the street. You don't have to look at, you know, USAID ad for donations to think about those people somewhere else. They're here. Affordable housing is on every public radio broadcast. Every mayor is talking about it, is getting reelected based on their plans for solving it. So I think that it's not a NIMBY issue anymore, right? Which is kind of mobilizing work. I think examples of kind of how this has worked is kind of what brings this to light. So I'll give an example of a recent investment we did. we invested in a company called Samunati Agrofinance. It's a non-bank finance company focused on lending to the Indian farmer, working capital loans. 67% of India's agriculture, of India's GDP comes from agriculture. And agriculture is not bankable because people don't want to take crop risk. Climate risk is huge. And people just don't understand how to deal with farmers. There's a lot of unpredictability. So here comes along a company founded by seasoned bankers, agriculturalists, who understand each value chain and how it functions. A dairy functions different from rice, functions different from sorghum. And there is a point in time where you can actually lend to a farmer to increase productivity and provide market linkages in a way that's useful, but also creates fantastic business returns and fantastic growth. This company is growing at 40% CAGR year over year. The company was founded 6 years ago by people who were visionaries, in my view, who thought about how, this need for the farmer to get capital. They didn't know how they'd do it. We come along in 2019 and lead a $20 million round of private equity through our growth equity phase, where we're convinced that this business model can be scaled not just in India, but potentially globally. And so to me, kind of the next 10 years will be about looking at these business models that have worked somewhere else and bringing them somewhere else, and thinking about how to integrate impact also in kind of the environment we live in. Buildings are a huge suck an emitter of carbon. And so how do you contextualize a developed market impact investment when you sit in a building? Well, you think about the glass. We made an investment in a company that's created dynamic energy efficient glass, which will cut the energy bill of your building as an operator anywhere from 20 to 40%. But it also gives your occupants, your workers, a connection to the outdoors. You're not sitting in a bunker. It has proven to increase productivity by 10%. Now that's a fantastic impact investment, but 10 years ago, that was a seed stage idea that we couldn't have invested in, but today we can, and there's plenty more examples like this.
Yeah. Jackie, what themes are you seeing people focus on right now?
So I think just to go off what you were just talking about, the themes that people are finding really interesting are some of those intersecting ones, right? So you have the last example there, environmental, right? And also workplace effectiveness. So some cross piece. Sure, the affordable housing continues to play, renewables, gender, but gender with a diversity inclusion, broader piece.
Tell me a little bit about that. What's your favorite topic?
It is a topic near and dear to my heart, thank you. Emily knows that I've talked about the materiality of gender to investors for some years. I think what's interesting in the gender space now is that when we first started talking about it, everybody said, yeah, I've heard of that. It's called microfinance, right? And while it is true that some microfinance is very beneficial to women, not all is. And oh, by the way, gender is broader than just looking at women. So now we're understanding this aspect of how inclusion, whether it's inclusion in boardrooms or inclusion in frontline workspaces matters, whether it's the founding team, right, or the funding team. And it's fascinating to see how diverse funders end up moving money and asking questions and viewing risk differently than funders who all went to the same schools, all had the same backgrounds, et cetera, et cetera. So we're talking broadly here, but the gender piece is the one obviously that has risen to the front earliest. And I think now we're sort of a massive conversation about intersectionality. But what's interesting about gender is that's where the data is best right now. So we have a lot more data of understanding where integrating gender-based factors in terms of risk and opportunity matter.
Yeah, well, let's ask you about data, because I know that's an issue that you're really working on and trying to make sure people really understand impact and understand how you're measuring it. What needs to happen to have good data about social impact as well as financial data?
Well, I think it's definitely emerging as we speak. And Rega spoke about some of the data that they've compiled on their portfolio, and we see many investors doing that all around the world, because I think ultimately as people are redefining how they think about performance, so it's not just financial performance, but also impact performance. It just begs the question of, am I doing a good job? And how do I have the data to actually understand the impact that I'm having, and how well I'm performing based on my overall expectations? At the GIN, we've been doing a lot of work on creating common like definitions and metrics. When we think about like the means by which we measure financial performance, we all know what those are. We take them for granted that we have standards there, but 100 years ago we didn't. When it comes to impact and things like how do you have an impact on financial inclusion or affordable housing or women's empowerment or other issues, we are working to build kind of generally accepted metrics. We just launched a new system called Iris Plus earlier this year, which actually allows you to start by theme or by sustainable development goal and find the core metrics that matter most for understanding your performance against that SDG. So you can pick SDG 5, which is focused on gender equality, or SDG 7, looking at clean, affordable energy access, and then figure out the metrics that you can use to measure your performance. That, of course, sets the stage for data, because once we have people measuring things in the same way, we can actually start to look at within portfolios and across portfolios what we are actually seeing from an impact performance standpoint. Just a month ago, well, I guess 2 months now, it's December, we published our first ever studies on looking at a cross-portfolio analysis of impact performance in 2 areas in particular, affordable housing and clean energy access. And we're working on the next ones, but I think it's starting to surface a really important conversation about how do we drive better impact performance.
Yeah, and so are these metrics that people have, are they usable yet? Or can investors compare with them?
Yes, no, absolutely. Yeah, you can. They're usable. They're freely available, and so you can go to the GIN's website, which is thegin with 2 I's .org, and you can look for Iris Plus, which is IRIS with a plus sign. But that you can. It's very easy and accessible, and will help you kind of get started. And connected to a whole bunch of work that other partners are doing in this space.
So I think we have a poll, Meg. We can pull that up a little bit if you get your app open. Because we've talked about this a little bit, where our poll is where can investors have the biggest impact? And we've talked about how a lot of this space has been in the private market so far. But let's see, where do you think investors can have the biggest impact, the public markets or the private markets? It's a battle, though the private market seems to really be winning. Why do we think that is? Jackie, why do you think the private markets are the place people feel like they have the most impact right now?
So I think if you start with the GIN's definition of intentionality and measurability, you very quickly went to the private markets, right? That's where you can start and look a founder in the eyes and say, what's your intention with this firm? And how are you going to be able to let me as the investor know whether or not I'm having the impact that we understood when we made our investment? Much harder in the public markets. But increasingly, we are seeing asset managers come to us with public market strategies and say, here's our intention, and here's how we're going to be measuring in this space. It oftentimes tends to be smaller, mid-cap, global strategies, as opposed to some of the large cap strategies. And the muni market is a space that is obviously ripe for that. Interesting work being done there. So I think you're going to see more work on the public market side in terms of what's happening from a more purely, if we want to define impact, on the sustainable, responsible impact spectrum. Obviously, also the activism that was talked about before is quite interesting. You're seeing some strategies that are doing very intentional work in terms of their engagement, and not just engagement in terms of holding companies accountable, but engagement in saying we're going to try and be out there and be matchmaking, bringing opportunities for impact to these companies that we are investors in, and specifically trying to spur positive impact, measurable impact from that.
Right. Rebecca, Nuveen has a whole public portfolio. How do you guys think about public markets versus private markets and impact?
Well, I'll let my colleagues who come on later talk about, particularly in the bond space, the amount of tremendous impact you can have, green bonds and such. I think the reason you're seeing this poll question turn out the way it is because it's the pure play. This is where great ideas are created. And hopefully they're nurtured to the point where one day they can actually access the public markets. We've had portfolio company examples where we've listed companies from our portfolio, and now they end up in the small to mid-cap funds, who can buy them. So it's, once again, this is this continuum of, capital that's becoming available, focused on the solutions in the space. I think also increasingly there's new source of capital in the private space that has the ability to take large companies and actually focus them towards areas of impact. So we have certainly seen companies where they may be actually providing something pretty basic, insurance, say life insurance or property and casualty insurance, to large swaths of the population, but they're not necessarily focused on the low-income customer. Now, if you take your impact investment dollars, invest in that company, and actually bring expertise on how to go down market, because that customer really needs insurance. They're much at risk of their entire life going to bits if they have a catastrophic event take place. They don't have a safety net. So if that insurance company that's already serving a mass market decides to go down market and really specializes, well, hell yeah, that's an impact investment, right? And particularly if you are driving that agenda, helping that company accomplish those goals.
Yeah, Amit, from your perspective, I'm curious about the public versus private, but
Sure.
also I was just going to mention that there was a big, as you were mentioning, going to public markets, there was a big success point this year with Beyond Meat's IPO. It's sort of one of those companies that started as an impact investment, and then it was the best performing IPO in 20 years, and it's come down since then. But that was a big success point for impact investors. And how many more of those do you think is possible to see, given that this market's existed for sort of 10 years?
Yeah. Well, I think that, to that overall point of public versus private, I think if you look at it from what the world needs or what the investor needs, we're going to have to think about how to have an impact across both. So if we're looking at big systemic issues like climate change or gender equity or other issues that we've already mentioned, you can't address those just by looking at small companies or big companies or just at private companies or public ones. But we need to be looking at how all companies are behaving and how entire portfolios are thinking about these issues. Also from the investor side, even most impact investors will start with a specific strategy. So it could be affordable housing or private equity and microfinance or so on. But then as they kind of understand the market a little bit better, build more credibility internally and more comfort and confidence about how to achieve impact while meeting their financial objectives, they tend to both deepen and broaden their portfolios. So many investors who do have diversified portfolios that started potentially in just private equity are then asking about what they should be doing from cash management, private debt, and so on down through their entire distribution. And so I think from both perspectives, you're kind of trying to address the issues and the impact we're seeking to have, or if it's trying to build out a portfolio, people want to be looking across the board. Not everything in public markets will meet the test of what we define as impact investing, but it doesn't mean that it doesn't have an impact, and that investors cannot be much more intentional and thoughtful about how to construct portfolios and work with companies to drive greater impact over time.
Yeah, there's just an article I saw come over the wire today thinking about public markets and private markets and places you can have an impact, and it said that most people who used to call themselves philanthropists today will call themselves impact investors. And I was curious, Jackie, is there any tension there? I mean, is there still, when you look at returns from impact investments, people are making money in impact investments, but is there any tension between philanthropy and impact, or trying to figure out where to use your money, or how are people playing that today?
So it's an interesting question, Emily. I think that there was some level, I remember being in this room probably 8 years ago, whatever, where we were having this question. I think it was right after the Philanthropy's new Passing Lane report was impact investing, that early report. And there was a real palpable fear among nonprofits that impact investing was just going to siphon massive money from there. We haven't seen that with our clients. It's not that there aren't some folks who have started to say, well, I'm going to use some of my philanthropic dollars as impact investments, but more generally, I'm taking my investments and saying, how does all of this have more impact and more opportunity? Now, I will say, when we talk with clients about impact investing, there's a lot of appetite for market rate. There's less appetite for concessionary investments. And we're really clear that we don't think you have to be concessionary. to have an impact and, you know, to be a responsible investor, and we can go into all of that kind of return sort of thing. But there clearly are places where impact at scale is requiring a capital stack, and that there need to be people who are willing to take different amounts of risk.
Yeah, I mean, how do you see that playing out for
Yeah,
your
it's something that we've, you know, the GIN's 10 years old, and we've been thinking about this issue since we, you know, were first launched, in part because one of the motivations for launching the GIN in the first place was this recognition that, you know, take any social issue locally or globally, and we don't have enough capital of what's available through philanthropy and government support to address those at a systemic level. And so the idea was, like, can we mobilize more private investment capital to complement philanthropy and the work of government? And since then, we've been very sensitive about, like, you know, which, you know, I guess pool of resources impact investing is coming from. We certainly didn't want to cannibalize philanthropy, and we haven't seen any, like, at least, you know, aggregate data that it has. You know, that, you know, the giving trends, at least in the U.S. where it's tracked really well, you know, tend to grow at consistent rates. And like what Jackie was saying, we see most of the interest and energy in impact investing coming from the, you know, market rate portfolios, you know, and so people who want to figure out how this comes from their kind of their investment pool of capital, not the pot of money they're planning on giving away. And so I think what's interesting as the market evolves, though, is how, you know, when you're thinking about an issue like climate change, how these different types of capital interact. And what philanthropy is needed for is typically not investable. And, you know, there's a lot of things that don't generate returns or revenue at all. And we can all, you know, I think, relate to those issues that we see in our own communities. And then there's a lot of opportunities where, you know, business and investment can play a very powerful, positive role. And we're far from maximizing the potential of that.
Yeah, how do your clients think about it, Erica?
Yeah, so I tell you, from our portfolio approach, we certainly take a risk-adjusted, kind of competitive risk-adjusted approach to impact investing. We're investing dollars for institutional clients. I will say, though, that there is some complementary work that happens on a company-by-company level or a project-by-project level. So, for example, in affordable housing, right? So we buy an asset because, one, we think it's an asset that's priced right. Our main objective is to keep the tenants in place. We want to keep rents affordable. The way we achieve doing that is, one, buying at the right price, but second, doing energy retrofits to reduce the overall kind of cost of operating that asset, because we pay the energy costs. Often there's underutilized or unutilized space in the first floor of the building, almost always, because it's a common space that there's no programming for the residents. And so that's where kind of playing with kind of, you know, budget dollars for partnering with nonprofits or other service providers who are looking for space, again, that you can kind of create win-win situations, right? So if it's a family-oriented property, perhaps there's a nonprofit that's looking for after-school programs, but they just can't afford the rents to be able to sustain that on their own. But they can come run those programs at our property, right? We give them the space for free, right? But then our residents have an option for their kids when they get off the bus at 3 p.m. to go somewhere and be productive while their parents are going to their second job, unfortunately, right? So that's an area where, you know, you can use the philanthropic community and kind of the nonprofit community to complement the work the for-profit impact investors are doing. The other space is kind of driving the research agenda at companies. So the company I talked about, Someone at the Agri-Finance, so it's doing something pretty innovative, right? It's focused on lending to the Indian farmer. But the philanthropists that are working with them and kind of giving them sidecars of capital are driving research on how to do this, one, better, how to take that research and go deeper into the markets, into the tougher markets, the tougher value chains, and actually long-term leave India and go to Africa. What does it mean to be successful to do agricultural finance in Africa? Now, the PE investors on the cap table are not going to fund that research because it's going to take 10 years to pay off. But here comes philanthropic dollars that can fund that, staff that in a way that's complementary to the company, and also kind of the PE investors are really excited about.
Yeah, that's a really good point. I think we often see philanthropy in this space sort of build some models out there that impact investors can then copy at scale. Amit, just looking at the whole impact space, I guess it's still very VC, private equity heavy, which is sort of a wealthy or institutional investor space. I mean, how do you democratize it so you can get more of the corpus of the capital markets involved in this space?
Yeah, it's this is an issue that I'm spending a lot of time thinking about, because I think if you've been looking back at the last 10 years and what's changed in impact investing, and a lot has changed. You know, it was something that was not a topic of broad conversation in investment committees and boardrooms all around the world like it is now. But one of the things where I think we have not made enough progress is actually making impact investing more accessible to folks who do not have family offices or private bankers or access to much more sophisticated portfolios. There has been an increase in access, so there has been progress on this front. But I think if you look at the data that was brought up in the last panel and before about kind of what people are seeking in terms of where they work, what they buy, and increasingly what they invest in. They want their dollars to be put to work to have a positive impact on the world, and I think there's going to be a huge opportunity for the financial services market to service that demand. I think a lot of big firms are working on this as we speak, including many that are part of this agenda. But I think it is something where we have yet to scratch the surface of the potential for ordinary folks who may have much more modest kind of investments, who want their money invested in a very positive way. There was some data and some research I found fascinating coming out of the UK. The government actually sponsored the first ever broad-based kind of statistically significant study of their population, and found that 68% of the UK population is interested in actually wants sustainable or impact investment products. And most of them don't have access to those if they go ask their financial advisor or banker. But that, I think, starts to surface some of the demand potential, even though that these kind of ideas are not that well known in the general population. So I think I think there's a huge opportunity for us collectively to really steer a lot more capital to things that have a positive impact.
Well, we have some questions from the audience, right? We have time for one or two.
We do. The first one continues on that theme, and this is directed to Jackie. As you just said, most of the adoption for impact and responsible investing is at the institutional, private equity, venture capital space. How do we connect with retail clients without having to come up with a bespoke plan for each client? How do we overcome the scaling problems?
How long do we have?
1 minute.
I think I'd echo what Amit just said. There's a lot of innovation happening, and there's a lot further to go. I do think that the not having to have everything be totally bespoke, I'm encouraged on that as we do more research with our clients. Their interests can be gathered, right, and grouped. And there are large themes that really do address issues, whether it's in climate and resource efficiency or in inclusion and gender, those sorts of things. And there are increasingly products that have a retail orientation with very low minimums that address those pieces. So it's a matter of we're starting to create total portfolios that have, it's a broad, sustainable portfolio with some very clear impact elements to it.
All right, time for one more, open to any of you. There's discussion about moving away from quarterly reporting to less frequent reporting for listed companies as a way of getting around short-termism. What are your thoughts on that?
Amit.
All right. Yeah. Well, I think we've heard a lot of interest in this. I think it's a very big shift because it's not only there's so much culture and machinery and infrastructure built around the quarterly cycle. It's how people kind of operate. Their incentives are built this way. Anything that's moving off a long-term trend, even by a quarter, usually gets punished by markets. And so I don't think this is an easy shift to make. But I do think that the overall focus on long-term investing, whether or not it abandons the quarterly earnings cycle or not, is something we're hearing a lot more about. I think it's kind of the pendulum. Many people feel this pendulum swung too far in one direction and needs to swing back. And one thing that we've heard, and you've kind of heard this come through the discussion, is that if you're thinking about institutional clients who typically are thinking about longer-term time horizons, in some cases intergenerational. If it's a retirement account or insurance or others, they're thinking about time horizons of 30 years. That once people start thinking about the long term at that kind of a multi-decade level, it's hard not to think about social or environmental issues because things like climate risk and inequality are dramatically reshaping markets and will affect kind of core financial sustainability. And so I think that the shift to long term will only mean that there's more interest in conversations like the one we're having today.
Yes, well, on that note, you guys can all have your own conversations now. It's the networking break, so you guys have some time outside, and you can come back at 4:05. And thank you, everybody, for a wonderful panel and discussion.
Thank you.